Greetings, members of the Institute of Chartered Accountants of Sri Lanka. This might be termed a very special event, in fact, an unusual one. So this is a forum that has been organized by the Institute of Chartered Accountants and on what we reckon to be a very timely theme and of interest to those who are in your profession. Now, this is being conducted remotely, as the saying might have it, although the panelists are assembled here at the center, namely at the Institute itself. But we reckon there are about 1,000 participants who are linked with us electronically via Zoom. But you are very much part of the event. And why we might say so is that you are welcome to be engaged with whatever is being discussed here, and whatever is not discussed or you would want clarified, you would be able to do that by submitting your questions or points that need elucidation in the chat box or by way of the Q&A facility, all of which are in your Zoom account or the arrangement that you have on screen. So either the chat box or the Q&A provision might be utilized to submit your questions. All right, so the theme, I think you are pretty much aware what it is, but here it is: currency depreciation and its impact on our economy. So this kind of topic has brought certain burdens in our minds, I'm sure, and anxiety, if I may even use that term. Now, we were due to have the From the beginning? Okay. From the introduction, okay, right. We were due to have the participation, as was mentioned perhaps and announced, due to have the participation of Senior Professor H.D. Karunaratne, who, as might be known, is the chairman of IPS, the Center for Policy Studies, but unfortunately he is, on account of a sudden requirement that has been placed upon him, been unable to be present here and participating. So we regret that. And so he is the chair professor of business economics with the University of Colombo and would have contributed, but sadly is unable to. But however, we have the others who were listed and meant to be part of this special event, in fact here. So we have Mr. Tilina Panduwawala, who is the head of economic research with Frontier Research. Then Mr. Malin Fernando is the head of group treasury with Haley's PLC. We also have the CEO or the chief executive officer of Hatton National Bank PLC, Mr. Jonathan Allis, and these are people you already know very well. And serving as moderator of this particular webinar or seminar or forum is the vice president of CA Sri Lanka, Mr. Heshana Kuruppu, to whom I will hand over proceedings in just a moment. But before we actually move into the conversation, we would like to have a presentation on this occasion, starting off with Mr. Tilina Panduwawala, who, as I've already introduced, is the head of economic research with Frontier Research. So let's listen.
Hi everyone, and thanks to CA Sri Lanka for having us today. Of course, we're facing a tough time. It's not just the currency depreciation that's on everyone's minds, it's also the other difficulties that's being faced in daily life. And of course, in addition to the float in the exchange rate that's pushed almost to around 300 rupees a dollar levels, we of course have seen significant moves in interest rates. Shortages and price pain on the economy as prices adjust to the depreciating rupee. But what's yet to come, and as part of the adjustment process for the economy, would also be interest rates moving higher in terms of the adjustment. Further price pains in the economy as price levels further adjust. Possible tax hikes as the fiscal adjustment needs to happen in the future, as well as possible contractionary pain on the economy, or at least in certain sectors of the economy, because of all the pain or the constraints that are being faced by the economy right now. Of course, this is a very severe crisis is being faced, and that's the reality that we need to face and accept and move forward over this year, but also for the upcoming years. And that is the kind of outlook that I want to focus on rather than the immediate term constraints as well. What this depreciation means to the economy and the economic outlook, and how firms in Sri Lanka, organizations in Sri Lanka should look in terms of that outlook and adjust. A big question, of course, is what does this depreciation and this adjustment mean for Sri Lanka's GDP? And in terms of this, we're looking at GDP per capita in USD terms in the chart. While GDP itself is a very rough indicator of economy's well-being, and per capita GDP particularly not the best indicator for individuals' incomes, it is something that affects everyone's sentiment about how the economy is doing and its outlook. So when we look at this kind of depreciation that we're looking at, right now close to 50%, as well as possible low to contractionary GDP growth in the economy, this means the GDP in US dollar terms as well would contract significantly. If we roughly take it as a US dollar 80 billion economy, this could push it down significantly to around 60 billion. And that means per capita GDP goes down to levels last seen in 2012-2013 levels in US dollar terms. And looking at that kind of view isn't ideal. It's not something we want to see, but that is the kind of reality that we need to now work with. And what does that mean? From a consumer point of view, is that a weaker consumer, especially in terms of imported goods and imported costs in terms of consumption. And recovering from those levels to go back towards the upper middle income aspirational level of 4,000 per capita will take time, because in the meantime we also can't push to a very quick recovery of the economy, because there is going to be the adjustment and reforms that needs to be implemented, and that will take time. So in terms of going back to those upper middle income levels, might take 5 to 8 years for us to go back there, for us to recover our economy to those levels. While this is of course not the ideal outlook to give for the medium term, this also seems like a rite of passage that other countries that are now in a better place, that have gone through similar economic debt forex crises have faced, where they've had to see contraction in their economies, in their per capita incomes. So especially with the Asian financial crisis of 1998, where a lot of Southeast Asian countries saw GDP contraction quite significantly, they have had these sharp setbacks, as you see in these slides for Malaysia, and it took them about 8 years to get back to where they were pre-crisis. Right? That is the period of reform and adjustment and recovery in the economy that they had to go through. Similarly, with Indonesia, about close to 10 years for them to go back to pre-crisis GDP per capita in US dollar terms. And similarly with Thailand. Getting the economy back on track with those reforms does take time, and that is something we will have to accept. And that recovery is what brings opportunities for firms in Sri Lanka going ahead. So the reality that we need to face is the delay that has been in terms of taking action taking action in terms of what's facing the economy. So even with very good policies, taking the right policies from here on, to face the reality that at least 270 per dollar rupee will be the reality going forward, and that tight fiscal and monetary policy will be required for a prolonged period of time to stabilize the economy and go into a sustainable recovery path. And of course, from a consumer point of view, we're going to have a poorer consumer who will also need to recover, and that will take time. Why am I saying that there might be tight policies for the coming period? Is now we see that the government has indicated that it's willing to approach our bondholders, our creditors, in terms of some kind of arrangement for our external debt, as well as starting negotiations, assistance from the IMF. And that seems the indicative path. So in terms of a sustainable recovery, be appreciated too much because they need to collect dollars from the market, non-debt related reserve accumulation. So that will require tight policy to continue for a few years if we are going to go on a sustainable path, and to give that credibility that we can in 5 to 8 years resume in full both repaying our ISBs that would be restructured eventually, and also to raise new debt from the international markets. At the same time, in the very immediate term, about balance of payments outlook, I think that's a good approach for me to take with the reforms that's being taken. How the outlook would really be, what would affect it. Recovery in formal remittances with the float, how much of that will happen and how quickly that will happen is, I think, an immediate one. On the other hand, given that we're looking at a poorer consumer, how would non-oil imports perform, especially in the second half of this year, as the impacts of this depreciation really come to bear? Would other imports contract beyond oil? We know there's an oil import problem and we can't really do much about it. We need to absorb that cost. But with the increased cost of essentials, fuel, food, would consumers be able to afford to consume consumer items, as well as for firms in terms of their investment decisions? Right, that will affect our import side and therefore the trade balance. And of course, our exporters have been resilient even through the COVID pandemic, but how more resilient can they continue to be, given they're also facing the challenges that all of us are facing on a daily basis in terms of electricity cuts, fuel, as well as confidence of their buyers. So that's also a question that will be there. Of course, the other side is the tourism recovery, and that's been a positive over the last few months. How strong will that recovery be in terms of getting inflows? But for me, much more importantly, will be the additional foreign finance. Especially in the near term, the one aspect of going to the IMF and also having a successful debt restructuring is that our bilateral and multilateral creditors would then have space to increase, provide new financing facilities. And that will be vital to both fund reforms in the public sector and other immediate investments in the economy. To unlock that, we again need to have that successful IMF program, debt restructuring, get that credible path out so that they can actually come in and support Sri Lanka. FDI and investment is something that will be something to look at in the medium term, because we first need credibility in coming out of this current crisis and show that we are on a sustainable path of reform. That path is what would unlock FDIs in the future. In the near term, I think what the government might look to focus on is whether there could be, state asset sales. That probably is where FDI can be unlocked in the very near term. But FDI into manufacturing exports, services exports will take time, and that is something that will require some time to go forward. But the key here is that the government's engagement on a clear communication on its emerging IMF and debt restructuring path, having clear communications with the creditors, the IMF, and also with the public as to what those plans are. Because otherwise, they might not be as easy as is assumed. Of course, going to the IMF is not something where we can get an overnight program. It takes time to negotiate. It takes time to negotiate with the creditors, bondholders to get these debt restructuring. So that process will have to happen. In the near term, we will need additional financing for our balance of payments. So that is in the very near term. But this will take a bit of time. And the outlook for the moment seems uncertain. And the certainty, to get that certainty, the government will need to have clear communications on its path forward. If there's a key takeaway I would leave you all with, it's that one thing, we are now dealing with consumers in dollar terms with purchasing capacity of about 2012, 2013. And a key thing that I would make in terms of the outlook is not to think of the possibility of a V-shaped recovery in terms of economic growth. 2023 might also be tough because there's the country needs to go through. As I said, tight fiscal policy, tight monetary policy, which don't really go well with a rapid recovery. Where the recovery could come in is as we unlock additional financing, do the reforms, and then start attracting FDI into the economy. And the export side will be a requirement to help support us get into a sustainable recovery path, getting to a point where in 5 to 8 years we can start repaying the debt that's possibly restructured. But this will take time. But the positive outlook and the way to see this kind of positive, gone through these crises before, and they've come out of them stronger, and how they've come out of them stronger by adopting the reforms required for the economies. Thank you.
Thank you, Tilina, for that insightful presentation. So next, how we would like to take this forum forward. After Tilina's presentation, I would like to invite Malin and Jonathan to share their views and give their remarks, and then we will start our Q&A session, and even Q&A is open for participants who are joining online, as Arun mentioned. So Malin, can you start?
Yes. Good afternoon, ladies and gentlemen. First of all, I wish to thank Sanjay and Heshan for inviting me for this panel discussion. I would like to take you through the dynamics that changed during the last 12 to 15 months in the foreign exchange market, and how it affected the balance of payment stress that we are in today. So if I start without going long back, if I started from the December 2020, we had a balance of payment deficit of about 2.3 billion, a negative balance of payment of 2.3 billion, with compared to $377 million surplus in the previous year, 2019. So we all know how it came down drastically, why it was negative. The main adverse impact that we saw is the reduction of the tourism income during 2020 because of the COVID pandemic, the first year of the COVID pandemic. So generally we used to receive about 3.5 billion worth of dollar inflows through tourism income, which came down to a number below $1 billion. So we saw about 2.5 billion drop in tourism income in 2020. And at the same time, we saw foreign outflows from the bond market and the foreign exchange stock market, which amounted to about $775 million in 2020. And also there was a significant reduction in inflows to the government in 2020 because we could not go to the overseas markets to raise some long-term debt. The inflows to the government in 2020 was about $2 billion, with compared to $6.5 billion in the previous year. So that was a severe threat to the economy at that time. So because of that balance of payment deficit, the pressure we saw exchange rate is started depreciating from 185 levels to 193 levels at the end of 2020 December. So throughout the second half of 2020, we saw the exchange rate was very much stable between 185 and 187 levels. But as I told you, latter part, it started moving to 193. But central bank took measures to stabilize the exchange rate to the best of their ability and crossed the year at 185 levels, 186 levels. So then we saw another development during that era, during that period. What was that? Because of the pressure on the exchange rate, imported came to the market aggressively to safeguard their position, the forward import bookings. So that also added some pressure on the balance of payment as well as to the exchange rate, where central bank was not very much comfortable at that level. Because in January, we saw the exchange rates started moving around 196 levels. So then the central bank took a measure to stabilize the exchange rate. They immediately banned in 25th of January. They took measures to ban the forward import booking because they thought that the main pressure for the exchange rate. So they thought banning the forward foreign exchange bookings will give some stability for the exchange rate. But I see this as a basically a kind of a pawn particular day from 205 levels to 193 levels within a day. So the central bank understood, so it's not easy to address the situation. So then they instructed banks to maintain the exchange rate level collectively between 199 and 200 levels latter part of April. And at the same time, in the month of May also, they revised the peg to between 200 and 203. And at the same time, there was another development. Central bank, the regulator, to address the situation, they advise the banks, okay, don't participate much in the interbank market, but try their level best to manage the inflows and outflows within the bank. So facilitate imports as based on their capacity to support with the inflows that they are getting from each bank separately. So that's where we saw initially the banks basically being very conservative in facilitating new imports. So that has led to this situation as well to an extent, because we saw shortage of industrial inputs and essential items and the fuel and everything. So that started with that. And at the same time, there were few adverse repercussions of maintaining the exchange rate at 200, 203 without allowing to change based on the demand and supply of the market dynamics. So initially, when they pegged the exchange rate at 200, 203, you know, so exchange rate tried to find its real value outside the formal market. So then it led to another market, informal market also started developing. So we saw a two-tiered market in the banking market, it's between 200 and 203. In the outside the formal market, it's started trading 205, 210, 215 likewise. So then one adverse effect was, now importers, they don't have any way of forward booking. Now, when the central bank advised the banks, don't participate in the interbank market, satisfy your inflows and outflows within the bank. So banks were not encouraging much or facilitating much of the early settlement because they didn't have adequate dollars in the banking system within their banks. So then the only option that the importers had was to apply a higher costing rate to safeguard against their risk. So we saw the interbank market is 203 or 202, but none of the importers we saw use applying that rate when they're pricing the products before they put into the market. So this started basically led to inflation as well, starting from June onwards. And at the same time, because this is a two-tiered market with two different rates, we saw drying up of inflows coming to the banking market as well, to the banking system. One example is the remittance inflows, work remittances that was coming to the bank. We saw a drastic reduction with compared to previous year. It dropped by about 2 billion rupees starting from June to December with compared to the previous year. So that went out of the banking market. It came to the country, but it came through a different channel. We didn't help to finance the essential items of the country. The third development is what we saw during that period is, so the shortage of dollars is there. Importers were not very much, the banks were not very much flexible in facilitating the imports because of the inability of the shortage of dollars. And the dollars is also in the curb market, informal market started moving up. So then automatically market participants started overstocking and front loading. So which is a common phenomenon in any economy. Even nowadays we know when we expect a shortage of fuel, we start pumping fuel from every petrol station that we pass. We don't wait till the fuel level comes to the bottom. At the same time, so when we are expecting the price of fuel to go up, at the same time there are a set of people who stock the fuel because of the affordability at a cheaper price. So the maintaining of the exchange rate at 200, 203, which is not the real value at that time. So basically it aggravated the situation as well, because we saw the outflows became very faster and larger in value, and at the same time inflows became very slower and lower in value. So one example what I can give you for that is the parents whose children are studying abroad. So during that period they got scared whether dollar will be available. They start sending money couple of months in advance as well. So the outflows became very faster and large in value. So that aggravated situation, we are narrowing the narrowing the balance of payment deficit at that time. So that was one reason why we saw that finally at the end of the year, the balance of payment negative was about 3.9 billion. So previous year 2.3 billion negative, the 2021 December, it was 3.9 billion negative balance. So then central bank, to arrest the situation again, they enacted another direction, mandating exporters to convert the entire 100% residual of that, but even that didn't help. So during the last 4-5 months in 2021, central bank has to dispose reserves about $1 billion to the market to finance the essential items and the essential food items and the energy bill. So finally, what happened was the reserves got depleted, and at the same time, though the one objective of the central bank or the regulator always want to maintain the price stability, so that's why they imposed a fixed peg of 200, 203, but the price didn't basically get stabilized. The inflation started moving up because the importers were not applying the same rate which was in the central bank website or the peg that was applied. Finally, we saw in this month beginning, first week, the central bank took a decision finally, having understood that all the measures that they adopted, the homegrown solution that they were expecting was not very successful. It was never giving the expected result that they wanted. So they floated to 230 initially, but then it is free floated. Now it is today's trading between 290 and 300. So the central bank also understood the first aid medicine for this kind of balance of payment stress is the floating of currency, but we have to understand that is not the only solution. There are a lot of other measures that they have to take into place. The policy, fiscal policy, things like that as well. Unfortunately, we don't have much of reserves to manage it or stabilize it immediately, because the reserve level at the end of February is about $2 billion. So if you remove the 1.5 billion which we have got from the Chinese swap, since we can't use it for meet our commitments or debt obligations, so we have left it only about $500 million. So because of that, it's very important to bring about a confidence to the market and the pragmatic solution how they solve this debt repayment that they have, and the engagement of IMF also very important. So that's where we are now. So I would like to take any questions at the panel discussion. So that's how we saw the market development in the last 12-15 months.
Thank you, Malin, for that synopsis and chronological order where we were and
Marlene, I'm left with very little to say, with Tilina covering the economy quite eloquently, and then Marlene not just covering imports and exports and the corporate, but he covered the banking industry as well. So let me try to bring in a few points in terms of in case they have missed, just from the banker's perspective. So for us, challenges emanated from even before the 2019 debacle of Easter Sunday, where, we were on the back of moratoriums and grace periods given for whether it was flood droughts taking place in different parts of the country. And then when the East Day that took place, it had an immediate impact on tourism and the supply chains. And since then, these industries have been in moratorium, and we've seen some of them not, repaying their debt or interest for the last 2-3 years. And most of them, we feel that they would come through. Some of them will need a lot of support support in terms of business revival from us, but it's a hard pill to swallow. There would be a few who would actually find it difficult to resurrect themselves at this time after such a prolonged absence of tourists coming in to the country and then using their facilities. Moving on from there, we had the COVID impact. The COVID impact, which really started to affect us from about March or so, whilst it had a severe social as well as health catastrophe to the country, which was quite well managed with some of the proactive measures taken by the country. The economic impact of it, we are still actually facing it. We basically found that in 2020, if you take the remittance part of it, actually it grew. And then we were analyzing how come the remittances were growing when all the markets were kind of closed. There was less work to be done, people not working. So I think it was a combination of the curb market or the Hawala and the Hundial being closed. And then secondly, the fact that we had some of our expats actually leaving the Middle East and other countries and coming back home, not just with their salaries, but with their terminal benefits as well, their retirement benefits, which actually propped the 2020, and that was pleasant from an inflow point of view, but not necessarily from a sustainable point of view in terms of income generation for the future, and whether these guys were going to go back or whether they're going to find employment within Sri Lanka, etc. Then what we saw at that stage, lots of discussions taking place, fully being aware that remittances was under threat and that tourism was not bringing the expected revenue. There was a understanding that this would have an impact on the budget balance of payments. And we slowly started to see import controls being introduced, and first, I suppose, on the list was there was a curb on the vehicle imports, and then that led to a few more which was termed non-essential. But having seen the 2021 numbers at something like $22 billion, you sort of start to wonder, actually, was there any controls? But some of the explanations already given in terms of stockpiling, making sure that we have adequate stocks. Marlene gave a good example of refueling when there wasn't a need, when the tank was half full or three-quarter full, is some of what we saw. And especially if it happened in the non-essential area, then that would have been had a significant impact on the balance of payments at a time when exports was just barely topping the 1 billion per month level, so leaving a significant gap and a void which would have normally been covered by remittances, by tourism, and then a reasonable amount of foreign borrowing, which was also absent, given that it was difficult with Sri Lanka's situation for us to import. And from there, what we have seen, I think Marlene has already alluded to the challenges that importers and exporters faced in terms of exporters and migrant workers thinking that the rates were not where they should be, and then using curb markets and the informal channels. Importers taking advantage at the lower rate and importing excessively, exacerbated the problem even further, which led to the point where we are today, where we have seen the currency being floated on the 9th of March and in the space of a couple of weeks, you've seen almost something like a near 50% depreciation. Now, you might think that those are not the real rates, but I guess something that we would discuss later in terms of what we have discussed all this time is probably the impact on financial economics. But the need to really kickstart the real economy, if you really want to get production going, if you really want to get productivity going. And I'm not necessarily just limiting myself to exports or the remittances or the tourism revival, which should happen as soon as possible. But I'm referring to the entire economy. All industries need to start firing all cylinders, and then what we really need to see is a lot of the discussions, a lot of the strategies that we have seen in plans over the last 10, 15 years, which have really not got off the ground. That's what is actually required to, let's say, anchor whatever debt restructure program, whether it's IMF or anybody else. I think the need of the hour is to actually look at, let's say, restructuring some of this, look at more long-term, longer the better, to get some breathing space till we get our economy back in shape. But while we do that, we need to make sure that this doesn't, we don't get back to this situation again. And to not get back means that we need to start getting productive, we need to start producing more, and that the real economy and the people should start working. Just doing nothing and expecting the numbers to, be massaged or sort of to keep changing in your favor is not something that's going to happen. And so it's a parallel effort that should happen. And whenever you have this discussion, many would say, but that's long term, that's medium term. But when you keep on pushing this to medium term and long term for the last 10, 15 years, that long term should have long passed. But we are still talking of medium term and long term. So when are you going to start is probably the question, and that has got to be immediate, whether it's grassroots level, whether it's SMEs, whether it's supply chains, whether it's agriculture, education, all that, health, all that needs to get more productive, start producing more, start generating more in terms of goods and services. Let's not leave the services industry. That can do so much more as well. That will bring more tangible GDP. As said, already the scare was already brought in terms of what would be the real dollar value of GDP. Yes, on account of the depreciation, it would significantly reduce. So the counter to that is, in case we are not going to get an appreciation of the rupee, then you start producing so that your goods and services rise and the real economy starts contributing to GDP, then starting to work on, exchange rates in order to work out your GDP. And that's what we all Sri Lankans need to do at this stage. We need to support each other rather than actually pointing fingers and doing the stuff that we all need to get involved. We need to support each other in making sure that all industries start firing. I can continue, but maybe I'll try and take it up at the point of Q&A.
Thank you, Jonathan, for that detailed explanation with regard to banking sector as well as overall economy and how you view it. So with that, I would like to turn to Thilina. Jonathan also highlighted we have always looked for short-term solutions and short-term policies in the expense of long-term. And in your presentation, you mentioned that there is going to be, for us to face this reality check, we need more tighter fiscal and monetary policies. And it has to be a prolonged period of time. So my question is, if you can just explain what kind of areas that you are looking at, and under fiscal and monetary policies, what can we expect if it is going to be implemented? And second one is whether it's 3 years, 4 years, 5 years. What do you mean by prolong? Any idea?
In terms of course, the obvious adjustment is from the fiscal side. It's accepted that we need to reverse the tax cuts that were implemented at the end of 2019, first of all, and then of course improve our tax system further beyond that to raise the tax to GDP ratio. Because given, for example, I think even last year, the interest payments to revenue ratio would have been close to 70%. And that's unheard of even at our credit rating peers, countries that have bigger problems, should perceive to have bigger problems, have better interest payments to revenue ratios than us. So that is, of course, a first step. And we can't really shock the economy too much in the very near term to raise revenues in the next 3 months, 6 months. It also needs to have a roadmap, a sustainable roadmap to raise not just, the VAT rate, but to raise income taxes, to improve the tax collection authorities. So that is a roadmap that takes a few years, and that has to be gone through. And we saw that with the previous attempt, with the previous IMF program, there was a multi-year program to improve tax revenues, and that was cut short. So now we need to, go back to the drawing boards from that point and, restart and improve the revenue side. So that's an obvious area of tightness, and that, of course, will be felt both by the consumer as well as firms in terms as a cost point. From the monetary policy side, of course, we've through the COVID pandemic, to support the economy, there was tax cut, interest rate cuts, monetary easing, and while that was justified at that point in time, given what we're facing in terms of balance of payments pressure as well, it's possible that interest rates might need to stay at rather elevated levels to keep a tight economy. Of course, if the tightening also happens from the price levels such as energy prices and as well as taxes, then that monetary tightening might be less than otherwise. So that is really, the factors to look for, because the monetary side, the central bank's target would be reserve accumulation from the IMF side. So that will be where they'll be really targeting at.
So any period that you think, this prolonged period of time, any idea?
So if we assume that we do have a successful debt restructuring process, that means that we get a 5 to 8 year pushback in terms of those principal repayments, right? So let's say in 2027 or 2030, we would have to start repaying those principals, either in one go or in tranches. So at that point in time, we need to be at a point where we have sustainability in our debt, not in terms of only our reserves at that point, but be able to go to the international market to borrow. So we also need to improve our credit rating, and that improvement, as I said, with the fiscal and the reserve accumulation will take time. So that 5 to 8 year period, the breathing space that we negotiate from our credit rating, from our creditors, from our bondholders, is really the time that we have to do that reform process, that tight policy.
So what you say is we will have to expect tax increases in months to come or years to come, and some level of increase in interest rate as well. And we'll have to go through that pain for next 5 to 8 years.
Ideally, if things are done much faster, and as Jonathan said, kickstart now itself, don't wait for the medium term, then of course, we might be in a better place in 5 years. Otherwise, it takes longer. Do we have to go to our bondholders again in 5 years and ask for another debt restructure? That will be the sad position. So avoiding that, we need to have a sustainable reform path over the next 5 to 8 years.
Okay, thank you. So Malin, turning to you, I think Thilina also highlighted the expected exchange rate OI to stabilize. I think you also mentioned we have seen exchange rate earlier it was moving 1 to 2 rupees. Now in a day, sometimes you see it moving 10 to 20 rupees. So what is your view? Because there are so many members joining here, as well as there are so many importers as well, and you are, I think, importer, net importer. So what is your view with regard to the exchange rate, and where would it, I'm sure it's a difficult question, but what is your guess?
Yes. Heshana, now during the last 2 weeks, we have seen a depreciation about 50%, right, 200. So what the numbers that we have to see is, there are a lot of outstanding payments. If I tell you like this, so during the rest of the year, we have to pay close to $4 billion, including the international sovereign bond, which is maturing in July. And at the same time, there are short-term swaps that are coming to maturity For an example, Bangladesh, $200 million, and ACU settlement we have deferred by about another 2 months, which is amounted to $900 million. And the entire market, if you see, in the banking market, banking sector, there's a shortage about, in my guess, in my view, about 1 billion to 1.5 billion deficit is there in the market. What is that 1 billion to 1.5 billion includes? So one is including the net open position of the banking sector, right? Plus, there are about more than 1,300 containers that have been stuck in the port without being able to release. So we have to source dollars for those as well. So, and also in the 1.5 billion, there are LCs that have got matured in the past, in the last couple of months. The bank might have settled the supplier from the dollars that they have, since it's a prime obligation to settle the supplier, but the bank have not settled the importer here. So that's also there. So, and at the same time, there are a lot of foreign investors who have sold their stocks in the Colombo Stock Exchange. They want to take their money out. So there's a severe shortage of that. That is very, very critical to the market. That is very, very painful to the market. The debt we can roll over, but those current transaction has to be taken place. So that 1.5 billion or 1 billion is there definitely. And at the same time, sovereign bonds, Sri Lanka development bonds, this month we have about 460 million, $50 million. So that have been rolled over. So central bank is convincing the banking and the investors to their level best to convince them to roll over. But again, they are investing for a very short period. The cutoff rate may be around about 10% levels. And again, in the month of May, there's another SLDB repayment. So these are short term. The debt, though it's maturity, so again, it's come to maturity in another 3 months' time. So that's again another pressure to the economy. So likewise, so there's immediate pressure, and at the same time, the total import book is open, right? So for a month, we, on average, we import about 1.5 billion roughly. So if we take the 500, let's say about a billion. So in the banking sector, the entire import book is open for the next 5 months. For an example, if I ask Jonathan, can he allow me to facilitate an import, use and sell, 30 days? You cannot. Okay, because your book is full. Your expected inflows and outflows in the next 30 days is full. If I ask him, can you allow me to open an LC which is payable in August? Still the answer is no. Sometime he might consider helping me in opening LC which is payable in December, where the book is to an extent he has the capacity. So meaning 1 billion into 5 billion is open. So all of us are desperately want to cover the position because already we have taken a hit of 100 rupees, right? So that is the pain of the or the cost of the homegrown solution that we have seen. So that has to be taken out. So immediately, so there's a pressure, and at the same time, still the curve market is moving at a higher rate, which I didn't think when it started. I thought the gap will be around 2 rupees, but it is more than 20 rupees now. So because of that has to be curbed, because the floating of currency will not help alone. Floating of currency will not help at all if the flows are not getting improved or the outflows are getting discouraged or curtailed. It's a never-ending thing. And the best is a managed floating situation, but even to manage the floating, we don't have adequate reserve at the moment. So we have to curtail that. So immediately, what I can say is there's a pressure. Okay, I can't say an exact word, exact number. If you want, I can tell you, but it may distort the market. But there's a tremendous pressure. So it has to be arrested. So how we can arrest or give the confidence to the market is through a pragmatic solution, how we are going to restructure the debt, how we are aligning the monetary policy. So monetary policy, if you see, starting from 7 to now, central bank has printed about $200 billion rupees during the last 2 weeks. And the interest rates have gone up by 3%. 3-month treasury bill has gone up by 3%. So printing money, increasing rate, printing money, increasing rate. Curd and honey, so never ending. So this has to be controlled at one point. So until we stop that, okay, there's no limit. It's like a kite floating on the sky without a direction. Right? So it's a pressure. So I'm happy if we can maintain below 300. That's a sustainable level, because initially economic participants can't absorb this, because already by February end we have seen inflation of 15%, and then with the recent devaluation, the fuel price have gone up already by 30 to 60%, super diesel, super petrol and the normal petrol altogether 30 to 40%. So that has got adjusted, all the cost of living expenditure has gone up. So industrial inputs cost has gone up, cost of production have gone up, cost of living has gone up. So this has to be arrested to a great extent. So I am happy if we can stay below 300. So that's the, at least for a short term period, if we can breathe, if we can stay below 300, it's good. But it has to be stabilized at certain point.
Okay, thank you, Malin. So stemming from his views, Jonathan, I would like to get your views. Like you also mentioned, Malin mentioned that the curb market being activated and foreign remittances drastically coming down. So now with this recent devaluation or depreciation, and now it is almost reaching 290, 300 level. Have you seen an improvement in inflows coming to the banking system by way of remittances and by way of export earnings and conversion?
Thank you. So what we saw in January and February was actually a reduction, and that was around 40% from, let's say, 2021, which we already now have recognized was lower than 2020 on account of, some of the examples we gave, the curb market being closed, etc. So against base which was already lower in 21, you saw 22 being even lower by about 40% in January, February. But the good news is that the past 2 weeks has seen a significant improvement in inflows. So whilst I fully agree with Malin that the curb market still exists, it exists around the pricing of about 310 to 320, maybe 315 is where it's going most of the time. But I'm just quietly optimistic that the way we saw the initial rates converge at about 250, 260 in the first week or the first few days, that there might be a happy medium and that our loyal and our grateful Sri Lankan migrant workers would actually then settle for, something close to what the curb market provides if we are, just a touch lower and we don't have to be on par, and anyway that convergence will take place if we are able to hold on to the rate for a reasonable period of time. And in addition to that, I suppose the government communications, the regulator and the banking industry communicating right throughout in terms of the pitfalls of the curb market and what it could entail. They may make more money on the exchange, but they could lose their shirt and trouser. And all it takes is 1 or 2 of those transactions to take place, and then all their hard-earned money goes down the the drain, and that would be a really sad thing to happen. And the danger is that when these sharks or the curb marketeers know that their time is coming to an end, whether we would see some slippage or default there, which I hope will not happen for the sake of our hardworking migrant workers who, really put in the hours in order to earn what they do. But that's a caution that they need to take, because what we don't want for the sake of another 10 rupees for them to lose their capital. The other advantage is if they continue to route the money through the banking system, they get so many other benefits. Like, I'll just give one example. Over the last maybe 7 months or so, I've been having let's say a gift program which is very, very attractive on a fairly significant budget, which means we have less interest in making money on that in this let's say transaction or this particular vertical. They are more interested in getting the money into Sri Lanka in terms of supporting the economy. Just a week or 2 back, in addition, we launched another program called Adhisthana, which in addition to the gift program, it goes on to issue you cards which has linked benefits. It gives you loans in order for you to get your ticket and visas in order to go abroad. In addition, it has certain SME and microfinance facilities for those coming back, as well as for the family to get involved in, some level of business locally in order to look at sustainable livelihoods and in terms of continuity. In addition to, these parents are abroad, we have a program that will keep the children also occupied in terms of their paintings, drawings, arts, various competitions as well. But that's just one. The engagement with the exchange houses, engagement with all our Sri Lankans overseas at this particular moment is a big responsibility for all of us here to make sure that we advise them, guide them on why they should actually route the monies into Sri Lanka through the banking system. And not because I am part of the banking system, but because I think the economy needs it, and also it gives them more security and stability. Even though, they don't make the maximum, it more than adequately compensates for the other additional, let's say, facilities that they could get from the banks, as opposed to getting a high rate from the curb market and then their local family members going into the black market, into the loan sharks and borrowing at phenomenal rate. It just kind of the trade-off is just not worth it. So that's my message to all of them. I think the time is right now. You've got the right rate that you want. Not so long ago, you were happy with, 150 rupees, maybe 2 years, 3 years back. Then you spoke of the 180 for about the last year, while the rates were at 200, you may have made a 230, 240. Now you're making, whether it's 50% on the board rates or whether it's another 20, 30%, that I would think is, reasonable return for the work that you're doing, and the time is right now. Whether you're an exporter or whether you're a, let's say, foreign exchange earner or a migrant worker, to bring the money through the normal channels, strengthen the Sri Lankan economy, and maybe even help to reduce the rate, while we all see the further depreciation, and which is on account of the fact that what Malin already and I think Thilin already alluded to, it was inevitable if you let it go that it would go beyond what is required in the absence of planning your real economy, as well as having a funding line to support to be able to defend it when it goes above. Had you sort of had that kind of twin arrangement, you might have been able to control the thing at least for a short while till you were able, till it got to a place where people would actually accept it as the normal rate.
Okay. So, Jonathan, in essence, what you say is it's not worth to take that 20 rupee or 10 rupee gain and go behind that high risk conversion, versus there are other non-financial benefits that a person who comes to banking system that they entitled to.
Very significant, Heshana, very significant. The risks are also very high. They're dealing with people that they have not dealt 2 years or 3 years back. Whereas you're actually, whilst, yeah, it's easy for me to say it, but 310 versus 290, there is a difference. But how sustainable is that compared to, what they've been doing for the last 20, 30, 40 years is, routing their monies through. And I'm telling you very, very sincerely, from the bottom of my heart, there's no question of us trying to make any revenues out of it. It's what we are doing right now in terms of the product programs in order to support, nurture the people who have actually, who are doing such a yeoman service for the country, is purely out of the love for them and the love for the country in order to bring the money through the banking system, which is a critical need of the hour. You can find all the reasons and excuses to say, the rate is not right, people are not using the monies properly, the controls are only with us, it's not with some others. You can bring all those conversations, but at the end of the day, we are Sri Lankans, and at this moment, Sri Lanka needs us.
Okay, I think it's a very good message, and even our members can pass this message to others because most of them are not sometimes financially literate. So we have that responsibility to communicate what Jonathan mentioned to other general public as well. So coming from that discussion, Malin, do you think Sri Lankan economy can absorb, let's say, curb market to be active? There is demand. So can this 320 or 330 levels of exchange rate, can it be costed and put back to the market? Do you think that there is going to be a tipping point anyway?
No, Heshana. Basically, the sharp depreciation is too much. That's basically because we didn't have any hedging mechanisms, any forward booking. It was banned, right? So that's why the entire import book is open. So non-essential prices, at least if we had the forward booking permission, or at least for the essential items, okay, it could have been a lot of help, but it was not there. So the entire import book, as I told you, the 5 billion worth of imports minimum, okay, it's open to the exchange rate risk. And if everything comes to the market, okay, it's very, very risky. So because of that, for the industrial inputs as well, for our cost of production, our exports, okay, so if it is going above 300 levels, okay, immediately it's very, very threatening for the economy and even for the cost of production and cost of living as well. So because of that, I feel we have to arrest this to a level below 300 somehow, until even for a short term period. Actually, Heshana, this kind of a thing happened in 2001 as well. Okay, major depreciation from 280 for the floating for the first time in the recent past in 2001 as well. But that was done parallelly with the IMF support while taking the corrective monetary policy action as well. So now only we are taking the monetary policy action as well. But since we don't have any reserves in hand, okay, since we don't have much of a capacity to have a managed floating environment immediately, which has to be done, okay, so somehow we have to build the confidence. As Jonathan said, we have to encourage the people who are working abroad to get the money, because they have already seen a 50% depreciation. It's the country's interest. So it has to be stay below 300 somehow, at least to between 260 to 280. Though it is difficult, there's a tremendous pressure, but we have to manage that situation at that level.
Okay, thank you. Thilina, coming back to Thilina, so I think we discussed about importers as well as remittances relating to the conversion. Now, there's another party who's benefiting from this depreciation, that is exporters. And you also touch upon, so Sri Lanka's export is around 1 billion, 1 billion a month, and it's year on year we have seen growth. So with this depreciation, don't you think we can be more competitive and our exports can go out and get more volumes coming to Sri Lanka? What is your view?
Thanks, Ashna. So of course, theoretically, if you are, dealing with the depreciated currency, theory says, it should be competitive, but then there's, as Malin also said, it's the cost structure, right? Firms are going to be facing higher fuel bills, higher electricity bills, and employees also need to be compensated for the higher cost of living. So those costs, the overheads for the exporters is going to rise, just like for all other firms. So even though they might get more rupees for their exports, they also need to contend with that. And on the other hand, we also need to realize that what our buyers are seeing as, this is the image of Sri Lanka. They're dealing with exporters, but they also need to consider, okay, how certain are our export orders, because, Sri Lanka is going through brownouts, 5-7 hour brownouts. So if there is any, breakdown in terms of the supply of our exports, getting them out to the buyers in time, that's, of course, an uncertainty that needs to be also accepted. In the near term, there's that risk for our exporters. But also in the medium term, they need to be aware that they need to also account for their costs. And the other thing is, of course, growing our exports, we need investment into the capacity. So whether it's the domestic investors or the foreign investors investing, they need to be given the confidence to have stability, macroeconomic stability, to keep investing and increasing capacity. So that will be critical. And as I said earlier as well, the reform path, the stable path, the sustainable path for the future will be vital to get the investment to increase capacity of our exports. That is critical if you're going to go beyond, 1 billion a month in merchandise exports and further from our services sector. We need that investments coming in. So for that, we need to have that, that we are past this crisis. We are overcoming it successfully and then having a sustainable path.
Okay, thank you. Jonathan, I think now what we see there is a breakdown in the supply chain because of the more than import restrictions. There is natural hindrance because of the non-availability of LC facilities, and there is you have to wait in a queue. So, how long importers and traders have to wait in these queues, in your view, whether it's 3 months, 6 months, or 1 year period, and what kind of infusion is required for the economy and for the country to stabilize and for us to move forward with the normal way of doing business? Or is it far from reality?
So firstly, it's already established that there's some level of import controls already in place, recently introduced. The restrictions we have, which following the 25% remittance to central bank being increased to 50%, further curtails our ability to service this import segment. It's not that the entire remaining 50% is used for imports. There are other areas we try to give some priority to the SMEs. There are some retail requirements as well, people traveling, education, health requirements. But by and large, most of it goes to support the import requirements. Some of them LCs, but at the SME level, we need to know that there's a fair amount which happens on DP basis, which has actually now moved to open account and advance payment in order to try and secure the import as soon as possible. But you're spot on, and I think so are the others that are we would be further curtailed through this increase in the transfer to central bank, which is obviously for a good cause. If that money is used for fuel, gas, and other essential items in order to keep, the lights on, to keep the factories open, and to keep, our logistics working in order to get the goods out, whether you're exports or doing domestic work. In terms of tenor and value, it's a big struggle, I would say. In terms of an amount that is required, the easy short answer is it's a big amount that's required. You need a few $1 billion if you want to talk of saying that imports can get back on its feet. But in terms of timing, I'm not actually looking at 3 to 6 months or whatever. My view is that if you really want to get the exchange to a reasonable level, and even if it's in the interim, the control float in the absence of the rest of it not being in place, the import controls will need to continue for a while, focusing on the more essential items coming into Sri Lanka, and could cross this year quite easily.
Okay. Yeah, so I think message is very clear. So we all the importers will have to see. So this is where I think then again challenge comes, the curb market getting activated. When the banking system is not available for them, then they go and buy it wherever available and paying that high price. So finally it's reflected in the price that customer pay. Coming back to Marlene, with regard to forward booking, I think forward booking is one of the risk mitigation strategies that was available, especially in Sri Lanka for importers. I think recently central bank revoked that, and now you can go ahead with forward booking. But have you seen there are active quotes in the market? In other words, whether there is any other way of mitigating risk if there are imports that are happening?
Heshna, that the forward booking restriction was revoked about 1 or 2 days ago, only yesterday, the day before yesterday. So since then, actually, I was a bit hopeful. Even I had my doubts to see a forward quote, but then after that, suddenly we saw that 25% got increased to 50%. So with that, I basically didn't have any hope, because even now there are a lot of payments that are in the queue in the banks. So because of that, immediately, and banks are still struggling to settle the payments, obligations, current transaction which are coming on the particular day. So because of that, I have not seen any forward quotes, though I was checking in the banking market. So immediately, I don't think, Haitian, that we will be fortunate enough to safeguard our position, the 5 billion import forward position immediately. So we will have to take the risk. There's no way out immediately. And at the same time, I would like to tell this as well. The litmus test to see whether this balance of payment trust is going out is again a forward booking. So the day that we can do a forward booking is the litmus test that we can see this balance of payment immediate stress is over. Until that time, we will not be able to do a forward booking. So it will take a while.
Okay. Tirina, there's a question from the participants. This is with regard to your example of East Asian countries and how they went through this kind of crisis. The question is, why are we drawing parallel to East Asian countries? Isn't it a unique problem that we encounter here? Or do you think there are similarities when you compare to East Asian countries? So what's your view? Or can we take some examples and do benchmarking here?
If you look at most of these crises, I mean, they have their own unique idiosyncratic features, right? Asian financial crisis isn't like the global financial crisis, and the current crisis that Sri Lanka and many other emerging markets are facing right now with debt distress. They're of course unique. So the Asian financial crisis was of course a much more of a sudden crisis that almost hit that region. So kind of different. Sri Lanka had this debt distress for the last 2 years. We knew this situation was coming, as Malin also very well explained the timeline. This was 2 years and more in the making. As Johnson said, even from 2018, we had stress on our financial system and on our reserves. So, of course, it's unique, but we can learn from other countries, whether it's their recovery path, the policies they followed, and of course, the events that happened and things that they had to deal with in terms of dealing with the IMF, with bondholders, with restructuring. Of course, there are even worse stories that we probably do not want Sri Lanka to be following, whether it's, for example, countries like Zambia and Suriname, which have been, going on an over 1 year road of trying to finalize IMF and debt restructuring. They still haven't found an end to that road of getting their debt restructured. So kind of like a, continuously festering wound that they have to deal with. So those are, of course, the very negative stories if we are not able to finalize the debt restructuring very well. But at the same time, it's not really to say that Sri Lanka is going to recover definitely in 8 years or 10 years, right? But that recovery, why I used AFC, was that the recovery takes time. And even for countries that were in a better place than us because they had good export capacity, whether it's Malaysia, Thailand, Indonesia, so even they took time to recover. And we know that we have trouble in terms of diversifying our exports. So that really emphasizes that role of diversifying our exports, whether it's merchandise or services.
Okay. Jonathan, I think you touched upon that there is some improvement in remittances as well as export conversion happening. And we have noticed there is a significant increase in tourist arrival as well. I think as per latest information, this year so far there had been 250,000 tourist arrivals, which is a good number compared to where we were in 2020 and 2021. And with this debt structuring discussions happening, facilities obtained from India and China, there is another facility being discussed. So does that mean now we have hit the bottom and from this point onwards we can see some positive trend?
I would hope so. Wouldn't want to see a further bottom than this. But you said all good things, Haitian, in terms of basically we need to, firstly we are hoping that we are seeing the end of the pandemic and then nothing, no further surprises in the horizon, and that would then encourage, I think what is really nice to see is lots of tourists who are longing to come to Sri Lanka and who had actually now postponed their travel for the past couple of years will be looking to come back. So maybe our tourism sector, the hotels should, gear up to accept these tourists and give them a really good experience so that they stay longer and then they visit us more frequently. We need to try and get back to the earlier numbers as soon as possible. We may not see it this year and next year, but if we can get reasonable numbers going, it will be foreign exchange that we did not see in the last couple of years. Already you alluded to the fact that if we can get the remittances coming and contain the curb market, that would be a huge positive as well, because these are pure remittances that come in terms of the most effective remittances are this, because if your exports, the exporters also do a fair amount of imports, so the net effect is lesser. Even in tourism, I'm sure that some of the hotels would be indulging in a reasonable amount of imports. But when you get a remittance, it's a pure remittance, and that's why it's so important to get the curb market curtailed and bring them back in. So any effort that is expended there is not a waste, and that's where all of us need to get together. In addition, I've probably started off by saying the importance of basically getting the real economy, and not just exports, but the entire productivity of the nation and the people to rally round across all industries in order to improve output, which has a direct impact on GDP. That with a good debt repayment plan will give confidence to Sri Lankans to go out there and do more, and to the international community as well, whether you're an investor, whether you're a rating agency, or whether you're waiting to bring in your foreign direct investment into Sri Lanka. And, I sincerely hope what we are meeting today at a point when we have seen the bottom, and then from now onwards, based on what we know is likely to happen, that it's good news from here onwards, though it would be a slow progress for a start.
Okay, happy to hear that, John. Thilina, so coming back to the monetary policy that you mentioned, there's a question as well. So now we have seen, I think, recent past also policy rates being increased, I think twice over last 3 to 4 months. And similarly, we see other countries like USA also increasing their policy rates. So I think with the aim of reducing or curtailing the money supply. So what is your view in next few months or next year to come, whether we will see further increase in interest rate? Malin, you also can add.
I think as we mentioned, discussed earlier as well by the others, the T-bill rates have kind of, gone ahead of the policy rate. They've risen much faster, and looking at the fact that they've really based, depended on 3 months rather than 12 months, means that the rates should actually be higher than they are on the 12-month, much higher than what's at the most recent auction. So it's not about whether it will go up. I think the policy rates need to be hiked. Part of the reason is to also support the float and try to give it an anchor. And also in terms of, the IMF and what we've seen from other countries that have gone through IMF programs, the IMF also tries to push countries towards raising their rates closer to, reducing that negative real rates gap. That's also happened in some of the other countries that's gone through IMF programs. So that monetary tightening should and ought to happen. And vitally for the current situation and with the exchange rate, critically very fast, quick, sharp rate hikes in the near term will be necessary for stabilizing for the forex market as well.
So what you expect is further rate hikes in months to come?
Yes, definitely.
Malin?
Heshana, the crisis that we are in, the stresses that we are in, we have never seen in our life, right? In Sri Lanka, even the more matured senior economists or senior bankers, also everybody says we have not seen this crisis. So the corrective measures that we have to take for that kind of a crisis to to get it under control is also going to be very, very drastic. The measures also has to be unprecedented measures that we have to take. Starting from last year, January 2020, January to now, we have printed about ₹1 trillion notes. And so during this year, we saw the 1% rate hike for the first time in 20 years. So that kind of measures has to be taken. And even as Tilina said, the measures that we have to take is going to be very, very unprecedented as well. Otherwise, we will not be able to arrest this situation, because we have to come to normalcy as soon as possible. The corrective measures has also to be very, very aggressive like that. So I hope the 5-year bond, the last time, the traded around 15.5 at the auction. Yesterday's 3-month treasury bill auction is 3 months higher than what was there in the 1st of March, 3% higher than that. So, but still the monetary policy, even after rate hike, there's a good arbitrage between that. So that has to be arrested. So I hope a large correction of interest rate has to happen in 2001, when a similar situation happened, when the country floated the currency for the first time. The bank rate went up from 16 to 25%, about 10% increment. A similar increment has to be given. It will be painful. It will be painful, definitely. But even a bypass is painful, but it gives you long life, it gives you survival, right? So the same thing has to be done at this time as well, because we have to disappear 1.7 trillion rupees that we have printed. But if they start printing money, increasing the rate, printing money, increasing the rate, so there is no end.
Okay. Yeah. Jonathan, you want to add anything?
I guess when they talk of increasing rates, Tilina talking of increasing taxation, and then you're talking of higher inflation, my mind goes to debt repayment. That triple whammy, if there was ever one, suddenly just creates my debt service ratios to just go out of whack. So maybe rates were not real when you took it. I do understand because of COVID, you maybe have taken it down, but did we have to take it so low? So then we have got to, at least if people were used to a normal 8 to 10%, and then moving from there to 12 to 14 to 16 might have been more palatable. Not so long ago, we were at 4 to 5%. And then to go 10, 12% up is pretty sharp. Yeah, some of those who are relying on deposit interest income would benefit, but then think about it. If inflation is so high, as Tilina, alluded to all this time, what is the net impact? Net of inflation and net of where the goods and services prices have taken us over the last 1 year. So from a banker's point of view, we are just coming out of moratorium. We have not seen some of our debts being paid for a while. We have had significant impairments over the last 2 years in preparation for that. But that was hoping that, when the moratoriums ended, that we would be in a nice space to start repayments. But now, even at that stage, when you are projecting higher rates, higher taxations, higher, let's say, prices and lower disposable income, so therefore, breaching all the DSCR covenants that are in place, it puts pressure on your repayment, and your credit impairment is under threat.
Yeah, I think we discuss many things as well as positives, negatives. So my last question to all three panelists, what is your message? So is there any positive things that we can take home? Tilina, starting from you.
Positive, of course, is, a crisis is a good space for reforms that this economy requires, with its, especially in the public sector, with our institutional background. Those reforms need to take place. And a crisis is a very good opportunity, because people see the pain that they need to go through because those reforms haven't been taken up for the last so many years. So I think it's easier to kind of try to communicate to the public as well that these reforms are required, to prevent them having to go through this kind of crisis again, for the children to stop having to go through these crises every few years. The saddest thing that could happen is if we have to go to our bondholders again in 5 years for a similar kind of restructuring. So we also need to communicate what those reform plans are to them and convince the public that this is, in the interest of the country, in the interest of everyone, that these reforms have to go through. That is really the hope that we can take out of this, and of the hope that the policymakers will push through those reforms, but with, communication with the public are most important.
Okay. Malik?
I have a very unique view about that. Basically, we are also responsible for this crisis because you and me have pumped petrol by giving a loss to the government from each time we pump a liter. So 50 rupees per diesel liter. So we have enjoyed that benefit. So let's pay it back to the government. So we have enjoyed it during the last so many years, especially during the last 2 years. Okay, our tax was reduced with the new policy decision. So we have enjoyed the benefit. Let's pay it back and let's correct it as soon as possible because we should have a life for our children because we have learned hard, studied hard, and we have done our best. All 3 of us, 4 of us, all of you, all the chartered members, you know how we have come to this stage with all the difficulties. So let's give it back to the country and resolve it.
Thank you.
So my colleagues on the panel alluded to there's never been anything like this before, and Sri Lanka has not experienced this, and what it requires, very, very strong, aggressive action. That having said, we have been in these situations multiple times and we have been given opportunity, and each time we say we are at crossroads and we never took the opportunity to really take advantage of the restructuring opportunity to get, let's say, the economy going and, bring some discipline into whether it was financial or economic management, whether it was fiscal policy, monetary policy, or the development of the nation. I think my humble request at this stage, do not let this opportunity go by. Whether it's for the sake of the future generations, our children, we need to have, lives to live. We need to live in hope. We need to give them a future which they deserve. Let's not be selfish. Let's not be irresponsible. All leaders need to come together, no matter what vertical of the country you belong to. This is a time to get together, work together, whether you're an importer, exporter, remitter, banker, whether you're in government, whether you're, in any institution. This is the time to really work hard, work together. We know what we need to do, but are we all committed to, making those sacrifices, tightening our belts? It is not only for the poor and those at the grassroots who have got to miss their meals and, start walking and, stuff like that. It's up to us also at all levels to, make it, tighten our belts and make sure that we conserve the little resources we have at this stage, behave responsibly, and then contribute towards this initiative in order to get Sri Lanka out and to get us out as fast as possible through very productive measures in, stimulating the real economy and managing this debt restructuring or whatever we want to call it that's going to take place, whether it's IMF or anyone else, in order to ease the burden of Sri Lanka's cash flows over the next few years. Let's do that in a very disciplined and a responsible way. So my final comment is for all Sri Lankans, let's work together, let's come together on this one. This is not a time to be, pointing fingers and working in silos, but to work as one nation towards one cause. We cannot afford to play around with the current situation that we are in. It is serious, but we are a resilient nation. We have come out whenever have been in these situations before. This is a the rallying call now to all of us to get together and make this comeback.
Actually, great message from three panelists, Tilina, Malin, and Jonathan. Thank you very much for that great message. Actually, concluding, yes, we are going to face severe challenges in terms of monetary as well as fiscal policy. They will be tightening. So as corporates, we need to get ready. On the other hand, as responsible citizens, we have this responsibility to communicate this properly to our illiterate general public, as Jonathan also mentioned, with regard to some of these remittances, conversion. So it's our part, I think, as members who are serving the society. And on the other hand, we need to look after our children and their future. So we need to do what is right, irrespective of our political views, irrespective of party that we belong to. So this is a time that we need to come together. I think we need to push our leaders also to keep aside those differences and come together. I'm hopeful that people will not go on roads and start strikes. Let's somehow communicate these messages to avoid that situation. That's the worst thing that need to happen at this particular moment of time. Thank you.
Thank you too, moderator and the panelists. And thank you also, our audience who was linked in for your engagement with that whole program. I think some fine material was heard. I think it can be encapsulated in one word, and it begins with the letter D, discipline. I think that comes into play at this moment, and the need to communicate in order to be able to manage that discipline of the mind and of the purse, as well as the policymakers. I think it's very important that this open discussion was held. At this juncture, we would like very much to invite the President of the Institute of Chartered Accountants of Sri Lanka, Mr. Sanjay Bandara, in the company of Dulani Fernando, who's the CEO, to please come along to hand over some tokens of appreciation to our panelists present here today, as well as our moderator. So I guess I'll start off with, in the same sequence I began the program. So we'll start with Tilina Paduabala, Head of Economic Research, Frontier Research. We thank him for his involvement with our special forum today. Followed by Mr. Malin Fernando, Head of Group Treasury, Haley's PLC. Then I guess we shall follow with Mr. Heshan Akurupu, in next in line, Vice President. And certainly Mr. Jonathan Alice, the Chief Executive Officer, the Hatton National Bank PLC. Well, that's it for now. Take care and bye.